So if you're raising that, are you no debt then in that scenario?
No, we've historically purchased with acquisition debt. So
Okay.
we raised 200,000. Now we usually leverage about 70 to 80%. And then, we're able to buy 2 to 3 properties per fund.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins.
Today, their firm, EM Capital, holds a portfolio across Indianapolis, Birmingham, Chattanooga, totaling 15 single-family rentals. Now, the key to this is patience is the key. Knowing how to be disciplined in your acquisitions, staying true to the math, trusting the math. So everybody, please welcome Dan Erb to the show. Welcome to the show, Dan. How is it going today, man?
It's going well.
Yeah, always fun part of opening up the show with, hey, what to say. I always like to say, what's the weather? And I know you're in New York, so what is it like up there right now?
Right now it's high 40s and cloudy.
Yeah. So we're recording this here in the beginning of April, the fourth month, and rolling into Q2 for those of us who are tracking that kind of stuff. So big turns, big things going on. And I'm excited about our conversation here, Dan. I want to learn so much about what you guys have going on. I love your background and your the other managing member of your team, EM Capital, his background and kind of where you guys ended up. So let's just let the listeners know where you've started. So you're not a physician, but you're coming from the I guess the investment side of things, and then now into real estate. Let the listeners know a little bit, Dan, about where you started and where you're at now professionally.
Yeah, absolutely. So thank you, Brett, for having me on. My background was not originally in real estate. It was in finance. So I went to Indiana University, where I was pursuing a degree in accounting and finance. And at the time, Indiana, and they still do offer this program, but they call it a 3+2 program. So you finish up undergraduate in 3 years, with an accounting degree. And then you go straight into business school. And while you're in business school, you could sit for your CPA. And so that seemed really attractive to me. And what it also allowed me to do was try out a bunch of different internships. So I wasn't one of those people that went to college knowing exactly what I wanted to do. I followed around my dad for his ventures in business. So I was originally born on the West Coast in Oregon, moved to San Diego, and then finally ended in New York. So I knew I wanted to do something in business, and I was pretty good at accounting. I liked working with numbers, and it sounds kind of nerdy, but I enjoyed the puzzle part of it.
Mm-hmm.
And when I was in business school, I was able to get an internship doing wealth management in New York. I then had an internship in Vietnam doing strategic consulting for a startup company. And then I also had an internship in San Francisco with KPMG doing transaction services. And it was almost through trying all these different things that I realized I wanted to go into an industry or a job that I was pushing myself. So I ran towards the 100-hour work week. I'm a big fan of Outliers by Malcolm Gladwell, and I was trying to get to 10,000 hours as quickly as possible. And so when I went into investment banking, part of the reason why I chose the firm Brown Gibbons Lang was because they work directly with entrepreneurs and founders. And, they do sell-side transactions for founder-backed businesses. And I really enjoyed working with the healthcare and life science team. And a large part of that business was working with physician practices across the country on selling to a private equity firm, either through a roll-up strategy or to become the platform practice. And, after doing that for a couple years, I saved up a good amount of money. I called my cousin, who is the M in EM Capital, so that partner you were talking about a little bit earlier. And he was working on Wall Street for the past 10 years doing equity research. And so I said, look, I have this pile of money. I've been expensing all my meals. I haven't been going out because I've been working so much, and I just got my first bonus. I want to do something in real estate because from taking my CPA exams, I knew about some of the tax advantages. And he mentioned that there was this opportunity in single family, and this was back in 2020. When you look at the housing starts and compare that to household formation, and you're forward looking in that analysis, from 2008 and 2009, we really stopped building single family homes, and that trend continued all the way up to 2019. And so there's the structural undersupply of single family homes. And at the same time, people were working from home. Millennials were reaching the age of 31 on a median basis, and they were starting to seek more space for their pets or, a starter home for, a growing family. And so we wanted to invest in single family real estate. I was in Chicago, he was in New York, and neither of us found those markets extremely exciting. However, from that 5 years at IU and flying into the Indianapolis airport 3-4 times a year, every year, I saw firsthand how much that city was growing and all the different initiatives that had come to life by the time I graduated. And so we ran that supply and demand analysis that we did in the US for single family homes, but double clicked into the Indianapolis market. It was almost like a eureka moment in terms of this is what we want to attack. And so we bought our first home using a traditional real estate broker. Then after we acquired it, hired a property manager, and they just had different incentives. They would give us different information. And, from my end, I wanted to work with one person. And I wanted to be the client that they thought about in the shower in the morning. And when they woke up, got into the shower, I want them to be thinking of Dan Herb. And so I went back to my experience working with physicians and how private equity's structured and incentivized physicians for the life of the investment. And I took some of those principles and applied it to single family real estate. And I ended up leaving my job in investment banking to pursue this full time because I thought it was such an attractive opportunity. And since I've left full time for EM Capital in January of 2022, we've grown from one property in Indianapolis to now 15 properties across Indianapolis, Birmingham, and Chattanooga.
Very cool. Very cool. And interesting. I have your website here, emcapllc.co, emcapllc.co. I'm looking at the team and some information on there, and it looks like your partner also worked with BlackRock for over a decade. So what an awesome pairing there, huh?
Yeah, I think the combination of his background as a capital allocator, as well as institutional research and quantitative research. So we're a little more sophisticated, or we like to think we're a little more sophisticated than the average mom and pop, landlord. But at the same time, my background in terms of structuring deals and working on transactions and what I think is kind of our secret sauce, which is the way we provide equity compensation to our local real estate professionals that serve as our brokers and property managers, has really allowed us to scale relatively quickly.
Yeah, that's great. I want to dive into all of that. But I want to jump back to something you said about to me, it was the analysis of the market, the submarket area, where you talked about household start versus household formation. What does that bring to mind when I say that?
Yeah. So when you think about real estate or residential real estate in general, it's a commodity product, meaning it's almost like oil and gas, where price is going to be dictated by supply and demand. And so the way that we look at supply and demand is on the supply side, the U.S. Census provides awesome data, as well as local counties providing awesome data on household starts each year or each month. And so this is readily available to anyone. And you could look at a county and see how many household starts have there been, for the past 5 to 10 years. When you compare that to the demand side of the equation, which is household formation, what we look for is population growth, as well as median age, because there's a big shift in home ownership from before 35 to after 35, where for people 20 to 35, home ownership rates are around 40%, a little bit under. And then from 35 to 40, home ownership rates are 62%. So there's this big jump around 35 where people are buying homes. And so we look at population growth and then aging demographics, and we divide those by people per household within the market to get an idea of how many households are being formed each year. And so when we compare the household formations to supply, how much housing starts are coming to market, and we see this big delta where there's a lot more demand than there is supply, that's when we get excited, because we think that creates upward pressure towards pricing.
And when you say household start, exactly what does that mean? Does that mean, hey, I'm ready to go buy a house, or what does that mean exactly?
That means you're filing a permit to build a house.
Okay.
So it's a forward-looking statistic where about 90% of starts come to market, and they come to market within the next 12 to 24 months.
And then how do we see the formation stat?
Yeah, sure. So we look at how many people are in the market, what is the average person per household. So these are all census statistics.
Yep.
And you divide what is the current population by people per household. That's a rough estimate for how many households are needed within the market.
Oh, okay. Very cool. So I've heard this also in a multifamily investor, where they're looking for these submarkets that have this formation, a certain number of formation, a percentage of formation, that tells them that, hey, they need more supply, right? And that's basically what you're doing on the single family side.
Yeah, but we look for these undersupplied markets because it creates upward pressure towards what you can charge for rent, and then what you would be able to eventually sell the house for.
Yeah, that's interesting. Now we're talking about structuring the deals, and when you say offering equity to your real estate professionals, your boots on the ground, whether it's the acquisition side or the asset, the property management side, offering equity gives them the buy-in to want to think about you, right, when they get up in the morning, because they're on the same team if you're doing an equity. So I guess talk to us a little bit about that structure and how you structure deals. Do you raise capital from other investors still to put all of this stuff together? So just give us a summary of what it looks like now at EM Capital.
Yeah, so at first it was just my cousin and I's money. And I think we were really smart to do that. And I would suggest to anyone that's looking to raise money that you should play with your own money first, because there were a few mistakes we made. When we started raising money, the way that we've structured the fund is we've looked to raise, call it 100 to 250,000 at once. And this allows us to buy 2 to 3 homes in the $250,000 price range. And so we were taking raised capital, purchasing properties through the fund, and on our side, the GP investment, we end up giving some of that equity to local real estate professionals based off of how many months they collect rent. So, if they collect 60 months of rents, they're fully vested in terms of their equity bonus. If they collect 30 months of rent, they're only 50% vested in terms of their equity bonus. And so we aligned our incentives where the person that's giving us the assumptions, the broker, for underwriting the deal, they need to hit those numbers, or they need to hit those figures in terms of what we need to put in the property for upfront renovations, and then also what we can rent the property for. Because if they're not accurate with those, they're not able to make as much equity as they would had they given us more conservative assumptions.
Mm-hmm. Interesting. And then what about so if you're raising that, are you no debt then in that scenario?
No, we've historically purchased with acquisition debt. So
Okay.
we raised 200,000. Now we usually leverage about 70 to 80%. And then we're able to buy 2 to 3 properties per fund. Across our different markets, providing diversification and things like that.
I'm just putting this together in my mind, so I appreciate you holding my hand through this. So you've got, similar to like a syndication, you're talking a fund, so you've got a GP and an LP, general partner and limited partners. And the limited partners are bringing in this capital. They don't have any liability in this. Maybe they have a equity multiple or something if there is a term, but they've got cash flow is what you're offering them. Is that correct?
Yes.
Awesome. And then on the GP side, when you're sponsoring inside of that GP vertical, then are you personally guaranteeing that debt if you're taking a commercial loan for these properties?
Yeah, we've had to personally guarantee our debt so far.
Okay.
What's nice about it though is that now that interest rates seem to be stabilizing, I don't know when timing is gonna hit in terms of rate cuts, but it looks like we've kind of hit the ceiling in terms of interest rates, at least for the short term. Now we can start refinancing as stabilized portfolio loans where they would be non-recourse, so we wouldn't have to personally guarantee.
Nice.
But it was a chicken and the egg situation in terms of getting these lenders to sign up with us because we didn't necessarily have a track record. Our earliest property that we bought was February 2021. And lenders wanted a track record in order to provide non-recourse loans.
Yes. You could just go into the table and just like, hey, my name's Dan. You're going to be thinking about me when you get up in the morning. I'm telling you, this is going to be great. It doesn't work like that. You need that empirical evidence. You need that backing in order to get this. And believe me, I've been through all of this, work with clients going through the whole thing as well, too. And it's all similar. So these loans out front, then were you doing DSCRs or no, you couldn't do a DSCR because, well, you could, but it'd be increased rate because you didn't have the seasoning if you're doing financed acquisition piece, right? So
we'd also buy vacant properties.
Yeah.
So we would want to find a vacant property and then lease it up. We'll take the leasing risk in order to buy the property at a discount. And I think what is really a reflection of our partnership model, and as well as our ability to underwrite deals quickly and accurately, is that of the 15 properties we've bought, and 13 of them have been purchased below third-party appraisals. And in the single-family world, that only happens 2.5% of the time. We're about at 90%.
One of that creates a challenge. Sorry, Dan. That creates a challenge where we leverage this. I love those opportunities. I'm going to leverage this ability to force appreciation, right? By making these repairs. I want to take the worst and I want to make it near the best. I don't want to make it the best. I want to make it nice, neat, clean, mechanically sound. I want to get that tenant in there. I want to get top of market rent. But the challenge we have in financing these in that scenario then is that the lender is going to look at the purchase price versus the appraised value.
The lender will on the acquisition loan.
Yeah.
But you can refinance once it's stabilized and point to the previous appraisal. So one of our most recent deals, it appraised for $242,000. We bought for $210,000. We also got a $5,000 credit. So this was an as-is appraisal, meaning the renovations and CapEx we were putting into the property was not included in that third-party appraisals report. Mm-hmm. So when we go back and get the property reappraised, once there's a tenant in place, we can go get a DSCR loan. And the new appraiser is going to look at the old appraisal and then as well factor in some more recent transactions. But it almost creates this equity that we buy on day one.
Mhm.
And when we're purchasing below appraised value and we're buying with leverage, we can get, a nice little cushion up front in terms of, the returns we're almost buying on day one.
Yeah. Yeah, it's all about the acquisition. And then after the acquisition, right, in order to really nurture the value, get as much of this deal as you can out. It's about knowing the process, knowing which loan product, the relationships you build with people who offer different loan products, knowing the process as well too, to really milk the opportunity out of these deals.
No, I think it's what we look for is low hanging fruit in terms of any value add.
Hmm.
So, we're happy to paint the inside or lay down LVP flooring. Those are really easy things in order to juice the value. And they're not necessarily risky. What we tend to avoid is anything that's, structurally unsound. Anything that, would require above, call it 10% of purchase price towards CapEx. And that's just been more so us being disciplined in terms of knowing what we know and knowing what we don't know. Neither of us come from a background of being general contractors. And while I think that there's a lot of value to being able to control that appreciation like you're talking about by being in charge of renovations, there's also a lot of you know
Risk.
academic studies and research that
Yeah.
show the risk adjusted returns
Yep.
are actually a little bit lower for value add deals than turnkey deals.
Hmm. Yeah. Yeah, absolutely. Yeah, and being that in my background of architectural engineering, construction management and engineering, general contracting, hands-on flipping houses, oh, it puts a smile on my face to think of all the blood, sweat, and tears that goes into those situations. When you do, as soon as you open up a wall, or as soon as you take a house prior to, say, 78 or 40, like there's these opportunities for more risk in groups, depending on the age of the house, the condition of the house, and all of those things. So I 100% agree with that. Um, what's been the biggest challenge so far for you, Dan, in building the portfolio?
I think remaining patient. So we didn't, neither of us came from a background that was directly covering real estate. And when I first started this, it was a great time to raise money. But I wanted to be patient in terms of making sure that the properties we're buying, we were very confident on, what the returns would look like, because early on, one bad deal would have crushed us or sank us.
Mm-hmm.
And so I wasn't as aggressive in terms of raising money when I first left. And then May of 2022 hit, rates started increasing, the tech market, crypto, things like that really started to bottom. And, people were a little bit tighter with their wallets. And so when we were finally ready to start going out and raising money and raise money, people were almost calling for this housing crash. 2008, 2009 wasn't that long ago. And a lot of people told us, what comes up must come down. And 2020, 2021 saw, significant growth in single family appreciation.
Mm-hmm.
And what held our conviction or, made us confident in the asset class was this fundamental supply challenge. And as interest rates rose and as inflation hit and labor became more expensive, now all of a sudden it's a lot harder to develop new homes. And so we weren't developing homes at a pace that I think would create, a housing bubble or housing prices to start coming down significantly. There were a lot of buyers on the sidelines in 2022, 2023. And when folks were, hesitant to move, we were aggressive. And so being patient, I think has really been been the hardest part, because real estate's a long-term game. There were some times where I felt, very equity rich, but cash poor. And, versus when I was working in IB, it was almost the opposite.
Yeah.
Wrapping my head around that was, it was a little bit of a struggle.
Yeah. Yeah. Equity rich and cash poor. And this time of the year, too, in tax season is always interesting when you see a number on paper that you have to pay taxes on and you don't have the cash to pay taxes on it. It's like, I don't even feel like I made this money. But when the idea is, hey, it's all, it's showing these things in equity or in reinvesting back in properties, it's a wonderful, wonderful game. What in a range, when I'm looking at single family investments, and I try to apples compare this across the board. If you were able to give a range of your preferred return pocket, and I want to look at it in two ways. What's the ROI and the cash per door per month, that net cash flow? What's a range that you feel comfortable targeting at on the acquisition side?
Yeah, so the way that we think about ROI is really cash flow before principal. And so if the cash flow before principal, or the cash on cash return before principal, I should say, is above the market interest rate, you expect that to be compounding and growing over time, which is something that we want. And really, when we look at our current portfolio, our cash on cash return before principal repayments is 10 to 15%. Then we obviously want a cushion in terms of levered cash flow. So that's after principal payment. So what is your cash flow, or that is month to month, basically? And we want that to be positive. And per door, I would say we look for, $200 a month on that fully levered cash flow. But to us, it's more important that we have a higher cash on cash return before principal payment. And then in terms of the fully levered cash flow, as long as it's positive in that year, and that's after unexpected CapEx or unexpected maintenance, we feel like we did a good job.
Why is the cash on cash return more important than the leveraged return?
Yeah, so that cash on cash before principal, it tells you what is your return on the investment, because what's going towards your principal repayments is increasing your equity value. So you're lowering your debt. Even if the price of the home stays the same, your equity value is increasing. And so if that cash on cash return is above the interest rate and you're taking out leverage on the acquisition, what happens is each year or each month, that cash on cash number is compounding and growing. And so our properties that we bought in 2022, when interest rates were relatively low, now that figure is 15 to 20%. Now that interest rates are a little bit higher, or towards 6 to 7%, we still want a cash on cash return before principal of 10 to 15%. I think the reason why the fully levered cash flow number, I don't want to say it's not important, because we don't want to call capital from our investors. We want our cash balance to be growing over time. That figure, to me, it's almost can be misleading, where you could be missing out on great deals because you're trying to get that fully levered cash flow up, or you're taking interest only loans at a higher interest expense because your monthly payment is a little bit lower. But after 5 years, you'd be better off taking an amortizing loan. Mm-hmm. And so it's not just one figure that we're looking at. I think it's the two figures in combination. We just want that fully levered cash flow to be positive and about $200 per door, because that gives us a nice cushion for unexpected maintenance and CapEx. but we're really looking at that cash on cash return before principal payments to decide whether or not a property is worth acquiring.
Mm-hmm. Do you ever sell?
We haven't yet, but we would love to.
Yeah.
Yeah, I think a few of our homes, we have great tenants in place. And yeah, we've been able to charge rent increases, and yeah, we have 12 months of visibility of rent payments. So we're not in a hurry to sell. But we've been approached by a few, call them a little bit bigger than EM, but still small institutions about potentially buying 10 homes from our portfolio. We've also been cold called a million times by wholesalers about selling some.
Yeah.
But from my end, I don't think, and I think that every first time home buyer should think this way as well, where if you want to make money off of a single family home, you really want to stay in it for at least 5 years.
Mm-hmm.
Because by that fifth year, a lot of your monthly payments to going towards principal, your equity value has increased substantially just from paying off some of your debt. And there's going to be a time, and I think Jerome Powell even mentioned this when he talked in his February Fed press conference, that the structural supply of single family homes is the reason why housing prices have grown despite high interest rates, and that there's nothing the Fed can do to combat that. That the U.S. needs to build more homes, and so if we saw start to outpace what we're forecasting for demand, that's when I think we would look to really move, or we'd be aggressive in terms of selling some of our properties.
Yeah, I always tell everybody I dread ever having to sell, like never wanting to be in a situation where I have to sell. And it just comes down to make sure that it's all about the acquisition. And if you've got your stuff together on the acquisition, you can cover yourself on the things that you may have missed, or the things that maybe once in a lifetime kind of scenario you could still cover and still sit, because just like you said, it's a long-term solution. And what I love doing is building long-term solutions with long-term people. And it sounds like with the way you're structuring the deals, Dan, that you've got this going and moving forward. Patience is huge. And it's really cool to hear your experience and learn about your deals through our conversation today. So thank you again for your time today.
Yeah, absolutely. And like one thing, just to kind of piggyback on what you were talking about, for anyone that is thinking about, going out on their own, or maybe leaving a steady income to pursue real estate, the best advice I could give is, make sure you're liquid at that time. So I had a good amount of money saved up, and on top of it, I had a bonus coming in. And then you want to give yourself runway, because like you said, there's things that you can't predict that will be bound to happen. And so I've been lucky that, I've been approached for consulting work. I've been approached to teach, but I've been approached to teach finance and accounting courses at universities and investment banks. And so I've given myself a lot of runway where, like you mentioned, I don't need to sell. And, I'm glad I'm in that position, because it wouldn't have been the right time to sell any of the homes in 2022 or 2023. We're in a much better position now if we were to sell the homes, and we have no pressure to do that. But it is something that we're evaluating for sure, or perpetually evaluating, because it's never a bad thing to lock in profits.
Yeah, capture. And then if it's set up right, 1031 exchange, go do it again. Do it again and again and again, and buy real estate and hold it forever. I love it. Well, thanks again, Dan. I appreciate your time. For the listeners out there today, it's emcapllc.co, emcapllc.co. You can learn a little bit more about Dan's team, their portfolio, and how to contact them as well, too, if you were interested in learning a little bit more about the investment opportunities, a little bit more about the markets that they're in, and maybe even some of their investment objectives rolling through there, too. Thank you for your time today. As always, thank you for your attention. Without your attention, your time is not worth a whole bunch. So thank you for giving us your attention today. If you have any questions for us, info@physicianwealthsystems.com. Send me an email. If you do get the chance, go ahead and leave us a review on Spotify or Apple. Those are really, really helpful. We get to hear from you that way too. So thank you so much. This is Real Estate Mogul MD.